What's going on? How y'all doing today? It's so good to see you. So good to see your smiling faces. And I hope y'all are having a great week. Today we're going to talk about life insurance. And more importantly, what we call in the industry, love insurance. Alright, so the first thing that we're going to talk about is what are the different types of life insurance. You might hear all sorts of people talking about term insurance, whole life insurance, universal insurance, and it's all confusing. And you think, what in the world do I need to do? Like, all this stuff seems so expensive. Like, I'm just trying to pay my bills. I can't afford life insurance, and my insurance agent wants me to buy a $300 a month policy that has all this cash value and other things like that. I can't afford it, you know? And so a lot of people are very confused as to, what can I do to protect my family in the event that I should pass or a spouse should pass. It's a big hardship, and so life insurance is one of those ways that makes it a little bit easier. It takes off the financial burden should somebody pass. All right, so I just spoke about why we need life insurance and the importance of it, and why it's important to spend that time to get a good policy, to get one that we personally recommend to people is level term life insurance. All right, so we sell those in 10, 15, 20, 25, and 30-year increments, level term, and so most people. The difference in cost between like a 10-year and a 20-year is virtually, it's not that expensive. It's not a big jump. So it's once you jump from that 20-year to the 30-year that you see not a spike in the cost of it, but a certain increase. And so most of our policies that we issue for people are 20-year, and that all depends on your age, your health, and other things like that. So for me personally, I have a 30-year. I'm young. I know I'm going to have several more kids. So I want to make sure that I'm locked in now at this young age when I have great rates, I'm still in good health. So I was able to fall into the best category with the best rates. And I locked in a good size policy. I have $1 million on myself, and I'm going to go into how much you need. But anyway, so I have a 30-year policy. So it's going to cover me through my kids, being born, the ones that aren't born yet, them growing up, and hopefully going to college, or at least leaving the house, and so that my wife is still protected through those crucial years where she might not be able to work full time and to be able to support herself and the kids. And so that's why I wanted to do a 30-year policy. Your situation might be different. It all depends on your age. If you're in your 20s, go for a 30-year. It's going to be cheap. If you're in your 30s to 40s, a 20-year is probably closer to what you need. If you're 50, 60 years old, a 10-year is probably about all you're going to need. A lot of people think that it's expensive. I fall into a very healthy category, and like my $1 million policy for 30 years, I want you to guess how much it cost me per month. Leave it in the comments below. All right, now that you've done that, my 30-year policy for $1 million, if I were to die right now, my wife gets $1 million. Yeah, don't tell her I said that, because she might try to scheme and get rid of me. $54 a month. Now, most people think that it is double or triple the amount of what a typical policy is. The next thing we're going to talk about is how much term insurance do you need to buy. I already talked about the term, 10-year, 20-year, 30-year, whatever, based on your age affects that. But then the next thing is how much. So I want you to take your pre-tax income. So for this example, we're going to use $50,000. Let's say you make $50,000 a year before taxes and everything else like that. I want you to take that and multiply it times 10. So I want you to have your base of $500,000. And then what I want you to do is I want you to add up all of your debts. I want you to take your mortgage. I want you to take your car payments. And I want your student loans are a little bit different. I want you to take your student loans that are not federally insured. The ones that are federally insured, they die with you. Meaning if you die and they're federally insured, it means that they do not pass on to your family members. But if they're not federally insured, then they will pass on to your estate, which means somebody's got to pay for it eventually. So I want you to take all those expenses. Let's say for this example, that's $200,000. You take a $150,000 mortgage, another $25,000 in cars, another $25,000 in miscellaneous, debts that you have out there. So $200,000. I want you to have a minimum of $700,000. And I'd love for you to have a 20 or 30 year, but if you can only afford a 10 year, that's all that matters. So a lot of people will tell you, hey, take your income, multiply it times 10, 12, 15, 30, whatever. But this is a basic, very simple 10 times your income plus your debts. And that gives you a good number to go off of. So some industry gurus are say 10 to 12%, and that's it, whatever. I generally like you to be around the 15% mark. So for that example of somebody who makes $50,000 a year pre-tax, I would want just a simple calculation, multiply that times 15. So 15 times 50,000 equals $750,000, which means I want you to have a minimum of $750,000 of term life insurance. Now, whether that's 10, 20, or 30 years, that's up to you and what you can afford, but I want you to have a minimum of 750. It'd be great if you could have more. If you can't afford it, just get the $500,000, whatever. I think regardless, even if you're a single mom, or especially if you're a single mom, it doesn't matter. If you make $20,000 a year, I'd love for you to start at $500,000. If you're young, it is so cheap to get that. And what's cool is you can always add to that over time. So let's say, I can only afford a 20-year term for $500,000 today. 5 years from now, I go, hey, I'm making a little bit more money. I want to make sure my family's protected. I could add another $500,000 or another $1 million, whatever. And they'll re-underwrite you. You'll have to do a new blood test and a new other things like that, health questions. But you can always add to it, so you can kind of layer them and stuff like that. So the next thing is for spouses. So let's say you have one breadwinner, whether that's the husband or the wife, whatever, and you have one spouse that is a stay-at-home. They take care of the kids or whatever. How much money do they need to have on them? And my answer to that is a minimum of, like I said, $500,000. As long as you have that, should they die, you'll at least have enough money to hire Mary Poppins. At least get through, if you have young kids, get them through the ages where you'd have to pay for daycare. And then once they get, 5 or 6 years old, then they can start going to preschool, kindergarten, and stuff like that. Which if you live in a city that has all of those, typically that's paid for with your taxes. So that's why we recommend at least just a minimum of $500,000. Love for you to get more, but a lot of times an insurance company, if they don't have any income, they don't like to do much more than that. They start asking questions going, why does this person need that much? And so then you have to explain, what your home situation is, how many kids you have at home, and other things like that. All right, final question that most of you are wondering is, what do I do in the event that my spouse or somebody dies? What do I do with this money? And the first thing that you have to do is nothing. I want you to take some time and don't do anything. You will get a check from the insurance company that you can live off of for a little bit. Don't do anything with that money. Just stick it in a savings account and don't touch it. I don't want you to make any rash decisions or anything like that. I want you to take some time. Take some time to grieve. This is nothing that we as insurance agents, we don't like to deal with this, but it's something that if we've done the proper things of making sure that you've gotten enough insurance and the spouse is taken care of financially, it makes the emotional side a whole lot easier. I want you to picture this in your mind. If your spouse were to die and there was no life insurance, now the spouse that's left, not only do they have to deal with the grieving your loss, but then they have to worry about the finances. That means they have to either go back to work if they're already working, or they have to go find a job, get a job. And that's something that you don't want to put your spouse or your kids or anything in that situation. Let's plan ahead. And this is insurance. This is strictly the worst case scenario. But in the event of the worst case scenario, we want to make it as easy on the family member as possible. So that's the first thing, is wait before you do anything. And then the second thing is I want you to take the time to hire a financial advisor. Now, if you watched my video previous, it was about the importance of a financial advisor. This is one of the reasons why you need a financial advisor in this situation. And so if you don't already have one, this is when you would need one. But get one before this ever happens. But they're the ones who are going to be able to take this money, and that is step number 3, is to take that money with your financial advisor and go invest it. I want you to go invest it in something that is very safe, that isn't going to rise and fall and get you crazy returns or lose all of that money, something that's very stable. And I want you to invest it, and then I want you to just live off of the income that is generating. So for that example, if you had a $500,000 policy and the financial advisor were to invest that $500,000, and let's just say it was a very safe one, it is making 6% return on investment per year. 6% on $500,000 per year is about $30,000 per year. And so that just kind of gives you a perspective of, okay, $500,000 invested is only making $30,000. So if I'm making $50,000 before I die, I need to leave my family with a little bit more money, $750,000, $1 million, so that they can invest it and at least kind of get back to where I was as the main breadwinner. So that's kind of everything in a nutshell. If you have any questions, be certain to leave them in the comments below. My contact information is on there. Be happy to answer any of those questions. Guys, it's been a pleasure. I appreciate y'all for being here each week. Hope y'all have a great week. We'll see you later.